People are keeping money as their asset and to make purchases. Interest rate and income are factors that affect demand for money. Interest rate is the expense or charge that the debtor pays to the creditor for a loan. Firms and the government loan money or funds by selling bonds, while households take out loans from banks or financial institutions. Money demand analysis can be categorized as classical or Keynesian.
Classical theory is the money demand that includes the quantity theory of money and the real balance theory. The quantity theory looks at how often money is used in a year, while the real balance theory is about how long people keep money as cash before spending it. While Keynesian theory exists due to Keynes' belief that people hold money for a certain period of time due to two factors. First is timing mismatch. Income is usually received monthly but spending happens daily. Second, economic uncertainty. In a good economy, holding assets is profitable, but during a recession, it can lead to losses. Now let's look at the motive people demand for money. First, transaction motive. Money is required to pay for the expenses of goods and services because money functions as a medium of exchange. For example, households hold money to meet daily expenses, while firms require money to make payments for raw materials and wages. Next, precautionary motive. Money is demanded to finance unexpected expenses because it functions as a store of value. For example, households set aside a certain amount of money to cover medical costs during illness, accidents, or emergencies. And speculative motive. Money is demanded for the purpose of purchasing financial assets such as bonds and stocks when their prices are low and selling them when prices are high to gain profits in the future. Now let's look at the money demand curve for all of these motifs. Transaction motive and precautionary motive is positively related to the level of income. The higher the income, the more money is held for transactional and precautionary purposes and vice versa. The demand for money for transaction and precautionary is not influenced by the interest rate. The demand for money for speculative purposes is inversely related to the interest rate. When interest rates are high, bond prices are low, so people buy bonds and holding less cash. When interest rates are low, bond prices are high, so people sell bonds and keep more cash. A liquidity trap happens when interest rates are very low, and people avoid bonds expecting their prices to drop.
Today, I will continue our presentation with determinants in money demand. Demand for money refers to the aggregate sum of cash which individuals are interested in possessing within an economy. The reason for such demand may differ according to the motive, since it may be due to precautionary, speculative, or transaction purposes. It is mainly influenced by interest rate and income. Apart from that, price level also impact demand of money, assuming if it is not constant. For interest rate is actually an opportunity cost of holding money, or dividend we can earn by holding bonds. Interest rate have a negative relationship with money demand, especially for speculation motive. It means that at a high interest rate, high opportunity cost of holding money will be produced. Because of this, people will prefer to hold less money. Meanwhile, at a high interest rate, people tend to hold bonds. By looking at the graph, we can assume that equilibrium is achieved at point E0 when interest rate is R0 and quantity money demand is M0. In a situation when R decreases from R0 to R1, quantity money demand will increase from M0 to M1. It happened due to low return from investment like bonds. Consequences of this situation, people are more encouraged to hold more cash rather than invest in bonds, which will give them less benefits. Conversely, people's demand for money will decrease when R is high because price for the bond at the same time is low. They tend to hold investment rather than cash, which will be more profitable for them in the future. This indicates that increasement in interest rate causes quantity money demand decrease. In terms of income and money demand for transaction motive are positively related. When income increases, it implies that people have the ability to buy more services or goods than before. Money demand for transaction purpose will increase. By looking at the graph, we can assume that equilibrium is achieved at point E0 when interest rate is R0 and quantity money demand is M0. If we have to presume that government expenditure expand, it means that our national income will also increase. This will incur boost in money demand. For example, our country, Malaysia, have an economic growth in the first half of 2024 to 5.1% comparing to the first half of 2023, which is 4.1%. That is what we call as an increasement in national income. Consequently, the money demand curve will shift to the right from MD0 to MD1. The new point of equilibrium will be at E1, when interest rate is R0 and quantity money demand is M1. Contrarily, the money demand curve will shift to the left when national income decreases.
What is the interest rate of equilibrium? The equilibrium interest rate is a critical concept in the money market. It represents the rate at which the quantity of money demanded matches the quantity of money supplied. This balance occurs at what we call point E0, where the interest rate is R0, and the total quantity of money in the market is M0. Now let's look at the graph. Understanding the equilibrium interest rate in the money market, the intersection of money demand and supply. The money demand curve MD slopes downward because as interest rates increase, people demand less money. On the other hand, the money supply curve MS is vertical, as the money supply is fixed by the central bank. The point where these two curves intersect is called point E0, which represents equilibrium. Decision making, cash versus bonds. In the money market, individuals and businesses face a crucial decision, whether to hold their wealth in the form of cash or invest in bonds. When interest rates are high, bonds become more attractive because they offer better returns. As a result, people are more likely to invest in bonds rather than holding cash. Conversely, when interest rates are low, bonds provide lower returns, making cash a more appealing option for liquidity. Above equilibrium. Interest rate too high, RN, R0. When the interest rate is higher than the equilibrium rate, say R1, the money supply, MS, exceeds the money demand, MD, creating a surplus of money. People will prefer to invest in bonds as they offer higher returns than holding cash. To restore balance, the interest rate starts to fall, making bonds less attractive and increasing the demand for cash. This adjustment continues until the interest rate returns to R0. Interest rate too low, R2, R0. When the interest rate falls below the equilibrium rate, say R2, money demand, MD, exceeds money supply, MS, creating a shortage of money. In this situation, people prefer to hold cash rather than invest in bonds because the price of bonds is high and the returns are low. In conclusion, the equilibrium interest rate is essential for maintaining balance in the money market. When the interest rate is too high, there's a surplus of money, which causes rates to fall. When the interest rate is too low, there's a shortage of money, leading rates to rise. Through this adjustment process, the market naturally moves toward the equilibrium interest rate, where money demand equals money supply, ensuring stability in the economy.
Now, let's focus on interest rate equilibrium, which is changes in money demand and money supply. Equilibrium of interest rate occurs whenever the quantity of money demand and money supply are equivalent. Therefore, each changes of money demand and money supply will change the equilibrium level of interest rate. One is changes in money demand. From the graph, we assume that initial equilibrium in the money market is at E0, where the money demand and money supply are equal and interest rate are at R0, quantity money are at M0. If government expenditure are increased and income will increase, people tend to hold money. The money demand curve will shift rightward to MD1. This will create excess money demand at current interest rate R0. This leads to increasing in interest rate at R1, where MD1 equal to MS until equilibrium is restored. Second one is change in money supply. Assume that increasing in money supply. The initial equilibrium in the money market is 0, where money demand equal to money supply, and interest rate are at R0 and quantity money equal to M0. If the central bank wanted to reduce the interest rate, for example, central bank reduce required reserve ratio, the money supply in the economy increase. The money curve shift rightward. This will create excess supply of money at the current interest rate, causing the interest rate to fall until the equilibrium is restored. Lastly, money demand and supply could change simultaneously. Assuming initial equilibrium in the money market where money demand equals to money 0 is at point E0, interest rate at R0, and quantity of money is at M0. Assuming increasing in economy, this will imply increase in income, then the money curve shift to right, MD1, and during the same period, the central bank introduced a monetary stimulus. Money supply will rises, the money supply curve shift to right to MS1, assuming the transition for both curves are equal. At E1, a new equilibrium is reached where interest rate is restored at R0, while the quantity of money increased to M1.
For the first one, which is nominal interest rate, it is the interest rate that is paid in the market. The nominal interest rate, also called as the market interest rate. For the first one, according to BEEBK1013, nominal can also refer to the advertised or stated interest rate on a loan without taking into account any fees or compounding of interest. This interest rate do not account for the value of inflation. Therefore, the formula will be real interest rate plus expected inflation rate. Let's take a look at this example. At the beginning of 2024, suppose you borrow 20,000 from bank that offers 5% nominal interest rate. To calculate the interest, you need to multiply 20,000 ringgit with 5% and you will get 1,000 ringgit. So the total that you have to pay to the bank at the end of the year is 21,000 ringgit. After that, we will look into this real interest rate, which has been adjusted for inflation to provide the nominal interest rate.
Real interest rate represents the true cost of borrowing or the real return on savings.
Real interest rate is the opposite of nominal. So the formula will be nominal interest rate minus expected inflation rate.
To sum up our presentation, we can conclude that classical theory of money demand consists of quantity of money and real balance theory. Second, Keynesian analysis of money demand motive is for transaction, precautionary, and speculation. In theory, the demand for transaction shows a positive association with income and a negative link with interest rate. Meanwhile, the precautionary demand occasioned a positive proportion to income and a negative ratio resulted in speculation as well as interest rate. This analysis exists due to Keynes' belief that people hold money for a period of time due to two factors, which is non-synchronization of income and spending, as well as uncertainties of economic situation. Besides that, interest rate, income, and the price level are the main factors that affect the demand for money. Additionally, total money demand is equivalent to the mixture of money demand for transaction plus speculation. On top of that, equilibrium of interest rate level occurs when MD equals to MS, or the intersection point of money demand and money supply curve. Besides that, there will be a change in equilibrium if the demand and supply of money changes.
Finally, the nominal interest rate refers to the interest rate paid in the market. It is known as market interest rate. It does not take inflation into account. Meanwhile, real interest rate is contradictory to nominal interest rate. It does recognize inflation.
So, I think that's the end of our presentation.